Hello, this is Andrea Horan with the third quarter commentary for the Agilith North American Diversified Fund. Markets continued their impressive rally in Q309 as evidence of stabilization and even improvement in some areas continued to materialize. In the quarter, the Dow and S&P both rose by roughly 15%, while the TSX and TSX non-resource indices were up by about 10%. The Agilith North American Diversified Fund had another strong quarter with the NAV increasing by 31%. This brings our one-year return to 55.6% and our two-year return to 25.5%, or 12% compounded annually. With markets up roughly 60% from the lows touched in March, many are asking whether the current rally is for real or whether markets have run ahead of the fundamentals. Back in March of this year, we articulated our view that markets had overcorrected and represented a generational buy. We remain bullish over the longer term as we see continued improvement in economic indicators and support for further growth from inventory restocking, which has yet to really begin. Stronger economic fundamentals have translated into improved earnings estimates. Finally, significant capital remains on the sidelines, earning little in the way of returns. As the central bank's quantitative easing programs wind down, we believe that this capital will be forced into higher return assets. Revisiting some of the forward-looking indicators that we highlighted last quarter, we note that the leading economic indicators index recorded a fifth consecutive improvement in August. CEO business confidence has also maintained an upward trend, rising to 63 in Q309 from 55 in Q2 and a low of 30 in Q1. Finally, the steady gains in the ISM report on business throughout 2009 continue to serve as a positive harbinger of improved business conditions going forward. Inventory restocking should augment economic growth in the coming quarters. As shown in this chart, the gap between production and sales has reached a 60-year record. As we move production to just meeting demand, GDP should be positively impacted by about 1.2%, and by more as inventory is actually rebuilt. We've also started to see the impact of positive earnings surprises on forecasts. After stabilizing the downward revisions last quarter, earnings estimates for the S&P have begun to increase. Moreover, the forecast growth in 2010 over 2009 has also started to expand. In this environment, we continue to favor growth business models generating excess free cash flow. We believe that the multiples on these stocks will be increasingly rewarded in a low-growth economic environment. We also look for industries that have removed capacity in the recent downturn, as these companies should demonstrate the best operating leverage in an improving environment, while companies that temporarily shut down capacity will likely have less leverage. We continue to like Canadian financials as their resilient business models should benefit from healthy margins on core loans, as well as improved capital market activity. Over the past few months, we've brought the beta of the portfolio down slightly as the market recovery has played out, but we continue to carry a beta slightly above 1 to reflect our positive long-term outlook. The portfolio remains well diversified across market capitalizations, with almost 40% invested in large cap stocks. Our sector positioning remains weighted towards technology due to the prevalence of growth business models, free cash flow generation, margin surprise potential at still attractive valuations. Prior to making any investment, we urge you to read through our offering memorandum, which you can obtain either by contacting us directly, going to our website, or clicking on the link attached to this presentation. Thank you.